If you're in the wealth management space, you've probably heard about infinite banking, where people utilize insurance policies, make allocations in the stock market or other regulated financial instruments, and then borrow against that while those appreciate and generate some type of return to be able to pay off that note. I think that this is going to be a huge thing moving forward, but not just in TradFi, but in digital assets. If you landed on this video, you're probably interested in the infinite banking concept and how you can do that with digital assets. Like, does that even make sense? And in what circumstances would it be applicable? How would you even orchestrate it? Likely, whoever you're borrowing from is going to have a tri-party agreement with you and one other individual. We provide that for our clients at Digital Ascension Group to allow our clients to be able to get access to liquidity against their digital assets. And the reason that you might do this, so most people, in the past have just sold the digital assets at the top and then bought back later on. The problem is you have tax implications. And, you can kind of get away with some of this stuff because the wash rule doesn't apply to digital assets. So if you are selling other things at the bottom to offset the capital gains that you had earlier, you can do it that way. And the infinite banking concept, if you didn't want to lose ownership of your assets, and you want it to continue to accumulate over time, but you want the liquidity, right? And you don't want the tax implications, because who wants to pay, capital gains tax is still going to be 20%. If you're in Canada, it's 66.7% if you're liquidating positions. So it's very advantageous in certain jurisdictions around the world to be able to borrow against your assets and not sell them. Most of the wealthiest individuals that I know have just continued to aggregate assets over their lifetime. If they have sold, it's been for very strategic reasons, or they're able to, defer those taxes when they sell, like you can in real estate through 1031. So you want some type of mechanism that allows you to access liquidity. Interest rates dropping over the last 50 years has been very advantageous for a lot of this and this concept. Again, and stock market has continued to appreciate over time, right? So if you own assets that you believe will continue to appreciate substantially over your lifetime, i.e., in this case, digital assets, then it could be a really great play to borrow against them early on and use that to fund your lifestyle, purchase other assets that cash flow, diversify, hedge yourself. I've seen, a couple of gentlemen that I met in Dubai do this really well. They buy in the bottom of the market in digital assets, ride it up. Sometimes they take profits. They're in Dubai. They don't have to worry about the taxes. But they're able to then reallocate those profits into real estate that cash flows and increases their position, their cash position, so that when there is a downturn in the market, they're able to take advantage. So I think that, it could be Bitcoin, it could be Ethereum. You've seen a lot of DeFi protocols and even institutions give loans against those two assets. I think that there will be other assets that probably move into vogue as utility comes in and regulation comes in around the space. But I think that that's going to be a big play for a lot of people that are in early in digital assets and do have significant positions in some of these protocols and networks. You'll be able to hold those assets with a qualified custodian, have them insured, work with a wealth management group or somebody else to be able to be the counterparty on those transactions. And as DeFi protocols come forward and are more progressive and implemented, you might not even need that bank or institution to borrow against. There could be a liquidity pool that you could put your assets into or delegate them to or have a smart contract with. Again, all of these things are progressing and changing on the daily. We're working with developers to be able to create some of those solutions for our clients. But in the short term here, especially, large financial institutions, Fidelity, BNY Mellon, Goldman, Citi, I think are going to be some of the big players that probably do have qualified custody for certain assets as we do see regulations get rolled out, and would be willing to, issue loans at favorable interest rates against digital assets, certain digital assets. So if it's not something you're thinking about, hopefully this puts it on your radar. Again, the wealthiest people that I know, they borrow against their assets. You often see this with tech startups and founders in that capacity. So Elon, to acquire Twitter, borrowed against his other stock. He sold some of his position in SpaceX. Zuckerberg, he pays himself $1 each year, and he borrows against his Meta stock. Same thing for Bezos. Bezos would borrow against his Amazon stock. So if you own some of these digital assets that are going to appreciate substantially and be used at scale across the globe, I think that you are in a very good position to be able to access liquidity at very low interest rates and provide yourself, again, a cash to execute business transactions or M&A, invest in private equity, purchase real estate, fund your lifestyle, whatever you decide to do for it. So if you haven't ever thought about this concept before for digital assets, hopefully this opened your mind to it and you found some value in it. If you have not, please like the video and subscribe, and we'll see you on the next one.